Hello, we're back. We're still talking about chapter 9, 9.1. This is finishing up. I, I, re, I backed up a slide, so we just went over this. Really important to remember because this is going to be on your homework. Um, you have to remember there's always two entries because you have to record, obviously the people that owe you money and your sales revenue. This could be cash if they paid you cash or sales revenue. And then we have to remember perpetual inventory. So we have to record the cost of goods sold and we have to decrease our merchandise inventory. Okay, so we're good on that. Just remember it's always going to be two separate transactions when you're selling a good to a customer. Seems very cumbersome, but it is just a beginning accounting class. So anyway, so that's good there. Okay, so let's go to the next thing, which is where I left off in the last video. So this one is going to be tricky because you're going to get it mixed up with the other one, but you can't because this is a separate account. This is a new account. Like cost of goods sold, merchandise inventory is a new account. This is a new account. It's called sales returns and allowances. And sales returns and allowances is a contra revenue. So contra, just like accumulated depreciation was a contra asset, a contra revenue goes against the revenue account. So the normal balance in a revenue account is a credit. Contra revenue is going to decrease your revenue. And that's what sales returns and allowances do in a real business. So the where this happens is not when you, Walmart, are returning a television to Sony. That happens, you decrease your merchandise inventory. We already talked about that. Now, in this case, you are now doing a sales returns and allowances, and that is because a customer bought the good and is returning it. So here's what happens. A customer returns a $950 TV that he had purchased on account. Okay, so think about what has to happen. So the accounts that are going to be affected is this guy's bringing back the $950 TV. So that goes against your revenue. So that's sales returns and allowances. So we have to keep track of those TVs that are getting returned, obviously, because if it's a problem, you're not going to want to buy your merchandise from Sony anymore. You're going to look for a new vendor. And then we have to credit Mr. Smith's account receivable. So he no longer owes us that $950. Okay, so we did that. We decreased our sales revenue by the sales returns and allowances, and we decreased our accounts receivable because we gave the guy back his money. Okay, then the flip side, we have to put the merchandise inventory back on the shelf. We're going to send that's another transaction later on. We got to send that defective TV back to Sony or wherever we bought it from. And we have to decrease our cost of goods sold. So that is going to be a credit. So you have to think about what you're going to do. So that's sales returns and allowances. Sales returns and allowances only goes from your business, Walmart, your feed store, to the customer. Okay, so it's a separate account just for things that are going to decrease your sales. So it's a contra revenue account, and that is the name of the account, sales returns and allowances. Okay, now let's talk about the sales discount. We already talked a little bit about a sales discount, so let's take a look at what that is. So we encountered it already when we bought our TVs from Sony, and they gave us that discount if we were to pay our bill within 30 days. So me, Walmart, has to pay Sony within 10 days in order to get the discount. Okay. This N/10 EOM, you never see it. I'm not going to ever give you homework, but this one is the real deal. We do use it in business all the time. It's a very important way for you as a small business to save some money. So you should know about it. So the credit period is the length of time allowed to pay the amount owed on the bill. So the credit period here is going to be 30 days. The sales discount is an account. Now it's going to be called a contra revenue account, because what we're going to do now is we are now going to give our customers, our best customers, the people who buy our inventory, not who we buy from, but who buy our inventory, we're going to give them a sales discount if they pay us within 10 days. So it's the same thing. It works both ways. So that is what a sales discount is. And a sales discount is also a contra revenue. It goes against revenue. So that means it is always going to be a debit entry. Revenue is always credit. So contra revenue is going to be a debit entry. I know it sounds confusing. We have to practice it so you get good at it. So what we're doing here then is you basically are giving your customers a 2% discount. So not the guy who brought the TV back, the new guy who bought a new TV. He buys the TV on account, and he takes it home, and you send him a bill, and on that bill it says, if you pay this within 10 days, we'll give you a 2% discount. Well, lo and behold, he pays it within 10 days. So what do you get in the mail? You get a check for $931. His 2% discount was $19. So his sales discount, that counts against your revenue, because you could have got $950, but we want our money quick, so we're giving him a little bit of discount, and we marked it up, whatever, $350 already. So we're giving him a little incentive to pay us quicker. So we have to keep track of that sales discount. And then we have to go to our accounts receivable, because he paid it. He paid that original TV when he walked out of the building. It was $950. So we have to credit his accounts receivable, so he no longer owes us any money. And if it would have taken him longer than 10 days to pay it, then this would be $950 here, and he wouldn't have qualified for the sales discount. So remember, from that date that is the good is purchased, if the terms are 2/10, you have 10 days to get your 2% discount. So that's a sales discount, and the other one is sales returns and allowances. So this is when your customers bring back defective merchandise. We give them basically their money back. If they bought it on credit, then we credit their accounts receivable. We keep track of the defective merchandise in sales returns and allowances, which is a contra revenue account. We increase our merchandise, brought it back, we're putting it back in merchandise. We have to take care of it a little bit later, but that increases our merchandise inventory, and it decreases our cost of goods sold. Okay, and then the other thing that happens is sometimes we give our customers a sales discount if they're good customers. So by doing that, you are actually going to take in less money, but you get the money quicker. And so you can turn around and buy more inventory and sell it and make money. Okay, last thing we're going to talk about in this section is sales tax. Everyone understands sales tax because we pay a lot of it in California. So remember that sales taxes are collected on all sales. Agricultural goods are sometimes subject to a different tax. Ag equipment doesn't pay full sales tax. And sometimes you don't have to pay sales tax on feed for livestock. But sales tax payable has to be forwarded to the state of California. So basically it becomes a liability, just like when you did your payroll and you had your OASDI, your Medicare, and all of those are liabilities. It's a liability. You owe the Social Security. In this case, you owe the state of California the sales tax you collect. So you collect it, but you don't get to keep it. So sales tax is on a cash purchase is calculated just the way you would. Some of you work in retail, so I'm sure you know how to do this. So if you buy that TV for $950 and you have this meager 5% sales tax, your sales tax is going to be $47.50. So the customer has to pay you $997, including the sales tax, of which you get to keep $950 and you owe the state of California $47.50. So I'm sure you kind of understand that. Let's see how it looks in the journal. So this would be in your T accounts, your ledgers. So the guy buys the TV not on account, but he actually buys it for cash. So he pays us $997.50. Sales tax payable is a liability. That is $47.50 in tax payable. And then we're going to credit our sales account because we get to keep that $950. That is our revenue. Okay. Okay, so this is a confusing little chart that's in your book. And so you have to remember that in some cases you are the seller. If you're selling to your customers, these are the possible accounts that you would have to use. If you are buying from your vendor, and your vendor in this case was Sony, then these are the accounts that you would have to use. So if you keep track of those, that picture is actually in your book. And I suggest you really look at your book as you're doing your homework. It's on page 306 in your book. Okay, so we are going to quit there. And sorry you had to watch 25 minutes of me, but I'm hoping it helps you out. All right, I'll see you next time. All righty, bye-bye.